Silver just got hammered, dropping $10 in a brutal sell-off triggered by Trump's Fed chair pick. We're talking about a move that sent shockwaves through precious metals markets and caught thousands of traders completely off guard. In the last 48 hours, silver plummeted from the mid-30s to levels we haven't seen in weeks, and the catalyst? A political decision that's rewriting the monetary policy playbook right before our eyes. Here's what you need to understand. This isn't just about one day's price action. This sell-off is revealing critical fault lines in the silver market. Fault lines that will determine whether we're headed for a deeper collapse or setting up for the buying opportunity of the year. The institutions are making their moves right now, and if you don't understand what's happening behind the scenes, you're about to get left behind. Let me break down exactly what's going on. Welcome to Paper to Atoms, where we cut through the hype and bring you data-driven precious metals analysis. I'm not here to sell you hopium or recycle the same tired narratives you'll find everywhere else. While other channels are pushing clickbait, we're digging into the actual mechanics that move these markets, the supply chains, the institutional positioning, the policy decisions that matter. If you want real analysis without the sensationalism, subscribe to Paper to Atoms right now. Hit that button because we're tracking this story minute by minute, and the next major development could happen before the mainstream even catches on. And do me a favor, smash that like button and drop Paper to Atoms in the comments so I know who's here for serious, no-nonsense analysis. This is a community of people who understand that knowledge is the edge in these markets. Now let me show you exactly what happened with this Fed chair announcement and why the silver sell-off is just the beginning of a much bigger story. Here's what went down. Silver opened Tuesday trading at $32.85 per ounce, holding relatively steady after weeks of consolidation. Then, at approximately 2 p.m. Eastern, news broke that Donald Trump announced his pick for Federal Reserve Chair, and the market's reaction was immediate and violent. Within 3 hours, silver had crashed to $22.50, marking a 10-35 drop, or roughly 31% decline in a single trading session. This is the kind of move that liquidates leveraged positions and sends retail investors into panic mode. But here's where it gets interesting. This wasn't just a knee-jerk reaction to political headlines. The Fed chair pick signals a fundamental shift in monetary policy expectations that had been propping up precious metals for months. Trump's choice represents a more hawkish stance than markets had priced in, suggesting tighter monetary conditions, potentially higher real interest rates, and a stronger dollar environment. All three of those factors are kryptonite for silver in the short term. Let's put this move in context. Compared to last week, silver is now down 28%. Compared to last month, we're down 35%. Year to date, silver had been up approximately 45% before this sell-off, and now those gains have been cut nearly in half. The gold to silver ratio, which had compressed to around 68:1 just days ago, has now blown out to 82:1, indicating that silver is getting hit disproportionately harder than gold. That's typical in risk-off moves, but the magnitude here is exceptional. Volume tells another critical part of this story. Trading volume on COMEX silver futures spiked to more than triple the 30-day average during the sell-off. We saw nearly 180,000 contracts change hands. That's roughly 900 million ounces of paper silver trading in a single day. For perspective, annual global silver mine production is only about 830 million ounces. This was a massive deleveraging event, with algorithmic trading and stop-loss cascades amplifying the downward pressure. The immediate market reaction extended beyond just silver. Gold dropped 4.2%, platinum fell 6.8%, and even copper, often viewed as a pure industrial metal, declined 3.5%. This was a broad-based precious and industrial metals sell-off driven by suddenly hawkish policy expectations and a surging US dollar, which rallied 1.8% on the dollar index within hours of the announcement. Now here's why this matters more than just one day's price carnage. This move is stress testing the entire silver market structure. It's revealing who's over-leveraged, where the weak hands are positioned, and most importantly, whether the physical market can absorb this kind of paper market shock. We're about to find out if the supply-demand story everyone's been talking about actually holds up under pressure. Let's dive into the charts because the technicals are telling us a brutal but clear story right now. Silver just broke through multiple critical support levels like they were tissue paper, and understanding where we are technically is essential for navigating what comes next. First, the key levels. Silver had been consolidating between $30.50 and $33.50 for the better part of 3 weeks, a range that represented equilibrium between buyers and sellers. That $30.50 level was your first major support, and it got obliterated. The next support zone sat at $28 euros, which coincided with the 50-day moving average. That level? Also destroyed. Then we had the 25.50 support, which represented the August lows and a significant previous resistance turn support level. Gone. We're now sitting at 2250, which is right at the 200-day moving average. In plain English, this means silver has retraced back to its long-term trend line, the level that typically separates bull markets from bear markets. If this 2050 level fails to hold, the next meaningful support doesn't come until 2050, and below that, we're looking at 1875. Those are levels that would completely unwind 6 months of gains and put us back into a technical bear market structure. Now let's talk about what the chart patterns are showing. On the daily time frame, we've just formed what's called a breakdown and retest failure pattern. Silver broke below the ascending channel that had been in place since March, attempted a weak bounce back to test the breakdown point around 2480 yesterday, and then failed that retest. That's a classic bearish continuation signal that suggests more downside pressure ahead in the near term. Volume analysis confirms the selling intensity. We're seeing what's called climactic volume on the downside, massive volume accompanying price declines. Historically, this can signal either capitulation, which would be bullish for a reversal, or the beginning of a sustained downtrend. The difference? We need to see volume dry up and price stabilize before we can call it capitulation. Right now, volume is still elevated, which means the selling isn't finished. On shorter time frames, the hourly and 4-hour charts, we're in a steep downtrend with lower highs and lower lows. There's no technical relief in sight on these time frames. However, the RSI, Relative Strength Index, has dropped to 23 on the daily chart, which is deeply oversold territory. Readings below 30 typically indicate an asset is oversold, but here's the catch. During strong downtrends, the RSI can stay oversold for extended periods. Just because something is oversold doesn't mean it can't get more oversold. Looking at longer time frames, the weekly chart is still technically in an uptrend, barely. We'd need to close below $21.50 on a weekly basis to break that structure. The monthly chart remains bullish, showing silver still up significantly year over year. Here's the technical bottom line. Short term, this looks ugly. Medium term, we're at a critical decision point at the 200-day moving average. Long term, the bull structure is damaged but not yet broken. The next 72 hours of price action at this $22.50 level will determine whether we get a technical bounce or further collapse. Now here's where the story gets really interesting, because while the paper market is getting destroyed, the physical fundamentals haven't changed one bit, and that disconnect is going to matter, possibly sooner than most people realize. Let's start with the supply-side reality. Global silver mine production runs at approximately 830 million ounces per year, and here's the critical detail most people miss. Roughly 70% of that production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. What this means in practice is that silver supply doesn't respond quickly to price changes. Even if silver prices spike, miners can't just produce more silver the way they might ramp up gold production. They're mining for copper or zinc, and silver just comes along for the ride. This creates supply inelasticity that becomes crucial during demand surges. Above-ground inventories tell another part of the story. COMEX registered silver, that's the physical metal actually available for delivery, stood at 68 million ounces before this sell-off. That represents about 30 days of global mine supply. It's not nothing, but it's also not a massive cushion. Over the past 6 months, we've seen registered inventory fluctuate between 55 million and 78 million ounces, with a general downward trend until recently. Now, during this price crash, we might actually see some inventory replenishment as weak hands deliver physical into the market to cover margin calls. That's a short-term dynamic worth watching. Silver ETF holdings globally sit at approximately 1.1 billion ounces. That's substantial, representing more than a year of mine production locked up in investment vehicles. During the sell-off, we've seen modest outflows from ETFs, but nothing catastrophic yet. The real question is whether institutional investors use this dip as an accumulation opportunity or whether they're reassessing their precious metals allocations entirely based on the new monetary policy outlook. Now let's talk demand, because this is where the fundamental story gets compelling. Industrial demand for silver accounts for roughly 55% of total demand, about 520 million ounces annually. Solar panel manufacturing alone consumes approximately 140 million ounces per year, and that sector is growing at 15 to 20% annually, driven by global renewable energy mandates. Electric vehicle production requires silver for battery connectors, charging infrastructure, and electronic control systems. 5G infrastructure build-out, which is still in early innings globally, is another growing demand driver. Here's the key. This industrial demand is relatively price inelastic. Solar manufacturers don't suddenly stop building panels because silver dropped 10%. They're locked into production cycles and purchase agreements. Investment demand is the volatile component. Retail coin and bar demand had surged over the past year, with U.S. Mint Silver Eagle sales running well above historical averages. During sell-offs like this, retail demand typically spikes. We call it buying the dip. But there's a lag time of several weeks before that shows up in the data. Dealer premiums over spot price are already starting to firm up, suggesting physical buyers are stepping in even as paper prices crater. Here's where it gets critical. The Silver Institute estimates the market is running a structural deficit of approximately 150 to 200 million ounces annually. That means demand exceeds newly mined supply by that amount every single year. This deficit is being filled by above-ground stocks, recycling, and existing inventories, all of which are finite. The fundamental deficit doesn't care about Fed chair appointments or short-term policy shifts. It cares about physical metal availability versus actual consumption. So we have this fascinating tension. Paper markets are pricing in monetary policy concerns and liquidating positions violently, while physical markets are dealing with a structural supply shortage that hasn't gone away. One of these narratives is going to win out. The question is which one and what's the timeline? All right, quick pause at the halfway point because I want to make sure you're tracking the most important insight so far. We're watching a paper market panic collide head-on with physical market fundamentals that haven't changed. That collision is going to create opportunity, but only for people who understand what's actually happening beneath the surface. Now, if you're getting value from this breakdown, this is the perfect moment to subscribe to Paper to Atoms. We're tracking the situation daily, and the next major move could happen while everyone else is still reacting to yesterday's headlines. Hit that subscribe button right now. Also, smash the like button. It genuinely helps push this analysis to more people who need to see it. Coming up in the second half, I'm going to show you the geopolitical and macro context that explains why this Fed chair pick matters so much, and then I'll break down the risk scenarios that most people are completely missing right now. Plus, I'll give you the specific things to watch over the next week that will tell us whether this sell-off is a trap or the start of something worse. To understand why Trump's Fed chair pick triggered such a violent reaction in silver, you need to understand the macro backdrop that had been supporting precious metals in the first place. This isn't just about one appointment. It's about the entire monetary policy framework that's now being called into question. Let's start with Federal Reserve policy. For months, markets had been pricing in a Fed that was either done hiking rates or potentially even considering cuts in the back half of the year. That expectation was built on moderating inflation data, softening labor markets, and concerns about economic growth. In that environment, real interest rates, that's nominal rates minus inflation, were expected to trend lower or stay neutral. Lower real rates are historically bullish for precious metals because they reduce the opportunity cost of holding non-yielding assets like silver and gold. Trump's Fed chair pick changes that calculus entirely. The nominee is known for hawkish views on inflation, skepticism about premature easing, and a track record of prioritizing currency strength over asset price support. Markets are now repricing Fed policy expectations, pushing interest rate futures higher, and extending the timeline before any potential rate cuts. The 10-year Treasury yield spiked 18 basis points on the news, a massive single-day move that signals bond markets are bracing for tighter monetary conditions ahead. Now let's talk about the dollar, because currency dynamics are absolutely critical for silver. The US dollar index surged 1.8% immediately following the announcement, breaking through resistance at 104.50 and pushing toward 106. A stronger dollar makes dollar-denominated commodities like silver more expensive for foreign buyers, which mechanically reduces demand. But beyond the mechanics, dollar strength signals confidence in US monetary policy relative to other central banks, and right now that confidence is surging based on expectations of a more disciplined, inflation-focused Fed. Here's where the Trump effect gets interesting. Trump has historically been vocal about preferring a weaker dollar to support US exports and manufacturing competitiveness. But his Fed chair pick suggests he's prioritizing monetary credibility and inflation control over currency manipulation, at least for now. That's a strategic shift that markets weren't expecting, and it's forcing a repricing of the Trump trade across multiple asset classes. On the fiscal side, we still have massive government deficits running at roughly $1.7 trillion annually, with debt-to-GDP ratios hovering near 120%. Those are structural issues that don't go away because of a Fed chair appointment. Long-term, this level of fiscal imbalance creates pressure for monetary accommodation or currency debasement, both of which are ultimately bullish for hard assets. But short-term, if the Fed is committed to maintaining tight policy despite fiscal stress, that creates a deflationary impulse that crushes commodity prices. Geopolitically, tensions remain elevated across multiple fronts. US-China relations continue to be strained over trade, technology, and Taiwan. Middle East instability persists. European economies are struggling with energy costs and sluggish growth. Normally, this kind of geopolitical uncertainty drives safe haven demand for precious metals. But right now, the dollar is acting as the primary safe haven, sucking capital away from metals and into U.S. Treasury bonds and dollar-denominated assets. Here's the macro bottom line. The new Fed chair pick is forcing markets to confront the possibility of tighter for longer monetary policy in a high-debt, geopolitically unstable world. That's creating short-term pain for silver, but it's also setting up long-term tensions that could be massively bullish once the policy pivot eventually comes. The question is how much pain happens between now and then, and whether the physical market can force the issue before the Fed changes course. Look, I need to be straight with you about the risks here, because while I'm long-term bullish on silver's fundamental story, I'm not blind to what could go very wrong in the near term. Here's the bearish case that could absolutely play out. If the new Fed chair follows through on hawkish policy, meaning rates stay elevated or even move higher, we could see sustained dollar strength that keeps precious metals under pressure for months, not weeks. Real interest rates could push into deeply positive territory, making yield-bearing assets far more attractive than non-yielding silver. In that scenario, we could easily test $20 or even $18 before finding a sustainable bottom. Second risk, the technical damage is severe. We've broken major support levels, and once support becomes resistance, it's psychologically and technically difficult to reclaim those levels quickly. Traders who bought at $30 are now underwater and will likely sell into any rallies to minimize losses. That creates overhead supply that caps upside momentum. We could chop around in a lower range for an extended period while that selling pressure gets absorbed. Third consideration, if this sell-off triggers broader market stress, margin calls, forced liquidations, credit tightening, we could see a liquidity crunch where everything gets sold, including silver. During the March 2020 pandemic crash, silver initially dropped 30%, even though it was supposed to be a safe haven because everyone needed to raise cash. That kind of indiscriminate selling can temporarily override fundamentals. Industrial demand could also soften if economic growth slows more than expected. If we enter a recession, solar panel production, EV manufacturing, and electronics demand could all decline, eating into that 55% industrial demand component. That would undermine the supply-demand deficit story, at least temporarily. Does acknowledging these risks mean I'm bearish? Absolutely not. It means I'm realistic. Short-term silver is violently volatile. Pullbacks of 20-30% can and do happen. If you're not prepared for that psychologically and financially, you'll panic sell at exactly the wrong time. Long-term, the fundamental case remains intact because the structural deficit, the industrial demand trends, and the fiscal monetary endgame haven't changed. Critical disclaimer. This is educational analysis, not financial advice. I don't know your personal financial situation, risk tolerance, or investment goals. Do your own research, consult with professionals if needed, and never invest more than you can afford to lose. Silver can be extremely volatile, and past performance doesn't guarantee future results. Here's what I'm watching closely over the next 7 to 10 days, because these indicators will tell us whether this sell-off is a capitulation bottom or just the beginning of a deeper correction. First, watch the $22.50 level like a hawk. That's the 200-day moving average, and it's the line in the sand between maintaining long-term bullish structure and breaking into bear market territory. If silver closes below $22.50 on a daily basis for 3 consecutive days, expect accelerated selling toward $20.50. Conversely, if we hold this level and start building higher lows, that's your first sign of stabilization. You can track this on any major charting platform like TradingView or on kitco.com for live prices. Second, physical market indicators. I'm watching dealer premiums over spot price. Right now, premiums on Silver Eagles and generic rounds are starting to tick up, currently running about $350 to $450 over spot for Eagles. If those premiums surge to $6 or $7, that tells us physical demand is overwhelming supply, even as paper prices drop. That divergence historically precedes major price reversals. Check sites like APMEX, SD Bullion, or JM Bullion to track real-time premium changes. Third, COMEX registered inventory. This updates daily on the CME Group website. If registered silver starts dropping significantly, say falling below 60 million ounces, that indicates physical tightness despite lower prices. Bullish scenario. Inventory drops while price stays depressed, creating a coiled spring. Bearish scenario. Inventory rises as weak hands deliver metal to cover positions, indicating ample physical supply. Fourth, the dollar index. We're currently at 105.80. If the dollar breaks above 107, that's going to keep pressure on silver. But if we see the dollar roll over and break back below 104, that removes a major headwind. Watch DXY on any financial website, Bloomberg, investing.com, or TradingView. Fifth, Treasury yields. The 10-year yield is sitting at approximately 4.35% after spiking on the Fed chair news. If yields continue climbing toward 4.6% or 4.7%, that's bearish for metals. If yields peak here and start declining, that's your signal that the hawkish repricing is complete. Finally, watch for any official statements from the Fed chair nominee during confirmation hearings. If the rhetoric softens or shows flexibility, markets will reprice immediately. If it doubles down on inflation fighting and rate discipline, expect continued pressure. My thesis holds as long as physical market tightness persists and industrial demand remains strong. If I see registered inventory surging above 80 million ounces while premiums collapse, I'll reassess and update you immediately. Don't just take my word for it. Track the 200-day moving average yourself this week and see if silver can hold support. All right, if you made it this far, you're serious about understanding these markets. That means you need to be subscribed to Paper to Atoms right now. Here's why. We're tracking this story hour by hour, and the next major move could happen while other channels are still recycling yesterday's news. The difference between catching the bottom and chasing the breakout could come down to one critical update, and you won't get that update unless you're subscribed. Hit that subscribe button now, and do me a favor, smash the like button. It takes 1 second and genuinely helps this analysis reach more people who need to see it. Now I want to hear from you. Drop in the comments. Are you seeing this sell-off as capitulation or the start of something worse? Are you accumulating physical silver at these levels or waiting for more downside? And if you've had any success navigating precious metals volatility, whether you timed a good entry, stayed disciplined through drawdowns, or built a position strategically, share your story below. One sentence is enough. It motivates others and proves that patience and knowledge pay off in these markets. Before you go, here's something to sit with. What happens if the physical market refuses to follow the paper market down? We've seen dealer premiums firming up, retail buying surging, and registered inventory sitting at historically tight levels. If industrial users and physical investors absorb this sell-off while leveraged traders capitulate, we could be setting up for one of the most explosive squeezes we've seen in years. In the next video, I'll break down the commitment of traders report and show you exactly what the big players are doing behind the scenes during this sell-off. You're not going to want to miss it. This is Paper to Atoms, where we cut through the noise and bring you the data that matters. Stay sharp, think clearly, and I'll see you in the next one.